2.5 million. 2.5 million multiplied by 35%. 875. So this depreciation tax shield needs to be added. So 4.42 million plus 875 gives you 5295. This is your relevant cash flow that you will use to calculate your NPV, right? So what we're going to do, we are going to calculate NPV now. NPV is equal to annual cash flows 5295 multiply. Since there are going to be, how many cash flows are involved? Since this project is going to last 8 years, so we are going to take the annuity factor for 8 periods at what rate? At 14%. So for 8 periods, we have 14% discount rate. And from this, we deduct our initial investment, which is 20 million. Is there any working capital recovery? Nothing. So what we did, just a quick review, 90,000 the market size, 30% belongs to us, 27,000 units. We can sell every year. Unit sells for 800, variable cost is 400, that is contribution is 400. So we get the total contribution. From this, we deduct the fixed cost. This is your before tax cash profit. You pay tax on this, you get after tax cash profit. And to this after tax cash profit, you add the depreciation tax shield, which is simply depreciation amount 20 by 8, 2.5 million times tax rate, 875,000. So this is the after tax or the cash flow that you should consider in computation. So if you take the annuity factor number for 8 periods at 14%, annuity factor 8%, 14% at 8 periods. This is 4.693, 4.639. So 4.639 multiplied by 5295,000 less 20 million, it gives you an NPV of 4563505. So this is the process you use using conventional tables. You need this number, you need the annuity factor and the initial investment, and you then calculate the NPV. We can do it directly by plugging in the numbers. I'm going to do it directly to save time. Our initial investment is of $20 million. Let's enter down. Then we have regular cash flows of 5295,000. Enter down arrow key, and there are 8 such cash flows every year. 8. Enter down arrow key. We need to calculate NPV, press NPV. What is the discount rate to be used? 14%. You press 14, you press enter down arrow key, and you press CPT. It calculates 4562784, which is approximately, this is more accurate number, right? And let's say if the question like this requires you to calculate IRR, it's just a one-step game. Press IRR, press CPT. It's 20.53. And rightly so, there is a sizable positive NPV. Desired rate of return is 14%. And you have generated a massive positive NPV. That means your rate generated by the project, IRR, would be much higher than 14% and perfect. It is 20.53, significantly higher than the desired rate of return. So that's the thing you do both ways. The calculator will help you quickly find out IRR and NPV. Moving on to another question. And this appears to be the question that might trouble you on the exam, because we need to, okay, IRR is given, fine. That's easier then. Yes, I told you on your exam, if you're required to calculate IRR, your annual cash flows would be the same. And in the worst case scenario, you may have cash flows of two types, 2,000 and 4,000. This is the maximum he can do, but this is an impossibility that you have all the cash flows which are different. Solving question like these on exam using tables could be a nightmare. And that's why you don't get question like these. But of course, such questions with unequal cash flows, you can find IRR quite comfortably using financial calculators. So let's see what this question says. Vacancy Incorporated has a cost of capital 12%, invested in a project with an internal rate of return 14%, IRR is given, desired rate of return is given. The project is expected to have a useful life of 4 years. All right. and it will produce net cash flow of 1,244 in the next 4 years. What is the initial cost of the project? First thing that will strike your head is, what the hell? What kind of question is this? What I'm going to do? Normally, we are given the initial investment, but in this question, cash flows are given, discount rate is given, but I need to find the initial investment. Don't worry, when IRR is given and you are required to calculate the initial investment, then make sure it is perfectly doable. You need to follow the idea. Remember, when you use IRR as a discount rate, your NPV is zero. When you use 14% as your discount rate, your NPV is zero. And when NPV is zero, what it means? It means your present value of inflows minus your initial investment, call it X, is equal to zero. You just need to equate this equation. So what are you going to do now? You're going to take your cash flows. You've got 4 cash flows, and you're going to write this way. First year cash flow multiplied by the first year discount factor at 14%. Don't take discount rate. Since we need to apply this equation, remember at IRR discounts, NPV is zero. So present value of inflows minus initial investment has to be zero. So first cash flow with the discount factor, first year 14% plus second year cash flow multiplied by discount factor for the second year times 14%, plus third year cash flow, 4,000 multiplied by discount factor for the third year, 14%, plus 4,000 times, you don't need to write this way on exam. I'm just giving you the idea that this is it. You can put the numbers directly and solve it on the rough paper and get the answer. It's just I want to make sure you are doing it rightly. So this is the present value of inflows minus initial investment, call it X, is equal to zero. Now what we have, the numbers I put it already. The discount factor for first period 14% is 0.877, 0.769, 0.675, and 0.592. If you solve all of this, what you get is 7,483. Minus X is equal to zero, which means you can equate this equation for X. This is your initial investment, which has given you a certain NPV, but we use 14% discount rate, so we were able to calculate this. Yes, Ahmed, perfect. You have calculated it perfectly right. So now let's say if we are required to do this question using financial calculator, what you will do, the first thing you will do is to clear your work, clear tables, and now plug in. We don't have cash flow at the year zero, so we can't put anything. NPV zero, that's we know for sure. We need to find the initial investment. We have first year cash flow as 1,000. So we take 1,000, press enter. We take 2,000 for the second period. Sorry, this is the frequency. I'm making mist. So there is no cash flow in year zero for now. Cash flow occurring at year period 1 is 1,000. Enter, down arrow key. You need to press it twice because there's no frequency. Second is 2,000. Enter, down arrow key twice. Then you have third cash flows 4,000. And this 4,000 is twice. Enter, down arrow key twice. Enter, down arrow key. All right. Now, we have inputted all the inflows. We don't have outflow. What we do, we take the rate which is given, press NPV, put 14, enter down arrow key, press NPV. 7,484. So which means the cash flows that you have entered, all the inflows, they're equal to this much of NPV, and which is your initial investment. So a question like this, which had no initial investment, you put CF naught as zero. You inputted first year cash flow, second, third, fourth. You inputted the interest rate, calculate NPV. This NPV itself will be the initial investment, right? So this, what you see on your screen is CF naught. Let me repeat this so the idea gets fixed in your memory. You have no initial investment. What you do, you have got just 4 inflows. You enter these inflows, you keep the CF naught as zero, no initial investment. Put in all these inflows respectively in the same way as we do. And once you do, put your IRR 14%. This is the rate that will help you calculate initial investment. You plug it in and you compute. The system will return NPV. That NPV is basically your initial investment. So you can do such question using the financial calculator as well. Now we are talking, see, now we are talking a bigger question that will surely will frighten you at the first sight, but you need to hold on, be relaxed, calm, composed, and follow a structured approach. And that says read the requirement. Using the net present value method analysis and ignoring the effect of income taxes, that makes things much easier. No tax shield. Please remember, when there is no tax rate, there is no tax shield. Finish. That makes things much easier. So the net present value of this product needs to be calculated when 20% is the cost of capital, desired rate of return, target return. So this is the rate we're going to use. Now, NPV is the agenda. And let's put up the number down. Gibber Corporation has an opportunity to sell a newly developed product in the United States for 5 years period. The product license would be purchased from New Group Company. Gibber would be responsible for all distribution and product promotion cost. New Group has the option to renew the agreement with modification. Okay. At the end of the initial 5 years term, you have the option to renew it. Gibber has developed the following estimated revenues and costs that would be associated with this new project. Cost of new equipment, $120,000. Additional working capital, $200,000. That is the initial investment you're going to make. And salvage value, this will occur at the end of the 5 years period. Now, sales revenue, $400,000. Cost of goods sold, $250,000. Out of pocket, cash cost, $70,000. Out of pocket means it's a cash outlay. So that makes things much easier. There is no debt and tax shield, so simply take the cash inflows and outflows and take the operating profit. No net profit or after-tax profit is required because there is no tax. We need to ignore taxes. So what do we have? We have an initial investment of $320,000, and we have an annual cash inflow of $400,000 less $250,000 less $70,000. 400 less 250 less 70 gives us $80,000. So $80,000 is coming every year for the next 5 years. So write down your equation. NPV of this project is $80,000 every year for the next 5 years. Multiply this with annuity factor of 5 periods at 20%. Step by step. You have just considered the annual cash flows. What about the working capital that will be recovered at the end of the 5th year? Put it aside. What about, working capital is $200,000. What about the salvage value that will be recovered at the end of the 5th year? $20,000. So this $200,000 is the working capital recovery. This $20,000 is the disposal proceeds. This is what you're going to receive net at the end of the 5th year. Now you might grumble, why are we not considering any tax benefit on disposal? There is no tax rate, no taxes involved. Things are much easier. So working capital recovery plus $20,000 of salvage value, the full amount is recovered at the end of the 5th year. So for this single cash flow, you use discount factor for the 5th period at 20%. That's all done. This represents present value of inflows, $80,000 every year for 5 years, $220,000 for the 5th year. Kullu inflows, all in present terms, deduct the initial investment, that is $320,000, and you are done. So if you do, annuity factor for 5 periods at 20% is 2.991. Discount factor for the 5 periods is 0.402. I'm sure you know how to do it quickly. This is 20%. And 20% annuity factor for 5 periods is given right here. It's 2.991. 2.991. And the discount factor is seen from present value $1. That is 20% 5th year, 0.402. Right? So when you solve this, your NPV is 7720. Right? Nearly 99% questions in your discounted cash flow analysis require present value of an annuity or a single period discount factor. There is one question, Ms. Maham, would you be nice enough to share a question which involves that you're going to invest in a project which will require you to dismantle a plant 20 years in the future? That's a fantastic question. Unfortunately, that isn't available in my system right now. I wish we could do it maybe in the next class, because that question moves in the opposite direction. Because what we have been doing so far, we are bringing future cash flows in present term. 7689. Maybe there's little rounding of error. Let me see. Let me calculate this. 80,000 times 2.991 plus 220 times 0.402 less 320,000. It's 7720. So please redo. Financial calculator. Okay, fine. So that question is a good one because it involves using these tables. We have never used these tables, but in that question we will. Future value of $1. If $1 is invested at 8%, after 1 year it's 1.08, after 2 years this much, after 3 years. So we will use future value of $1 and future value of annuity. If $1 is deposited every year, that $1 in year 1 and 2 is combined 2.0. So this is the point that we will be making use of, future value and of a single dollar and future value of an annuity. So that particular question is a must do, and I will find it. Maybe Ms. Maham will share, then we'll do it in the next class. So this will help you manage any question involving future value of cash flow as well. So that is a must do thing. Now let's do this part using financial calculator and see what it says. 220C. Ahmed, additional working capital, it will be recovered at the end of the 5th year. And this salvage value of equipment in 5 years, this will also be recovered. So sorry, this 220 and 220,000, a total of 220. And we are going to calculate a single cash flow for the 5th period. 5th period, 20%. Single value discount factor, this is a 0.402. 0.402. So this is it, 0.402. So let us solve this using financial calculator. And let's see how do we put the numbers. So first thing first, clear the counters. And now plug in the numbers. Your initial investment is 320,000. Negative. 320,000 negative, enter. Now we have 5 cash flows of 80,000 each. So we're going to put 80,000. Enter. Down arrow key. There are 5 such payments. Enter, down arrow key. Then there is a single cash flow coming at the end of the 5th year. 220. And frequency is 1 only. So you press NPV. The rate you're going to use is 20%. And then you compute. It is 7073. That's quite a sizable difference. Ahmed calculated 748. Did I make any mistake? Or maybe I need to split these cash flows up. I'm going to take 80,000 for 4 periods. I'm going to take 300,000 for the 5th period. That can work. I am going to split this 80,000 in 2 parts. 4 payments of 80 each with the annuity factor. And then I have a single 80,000 combined with 220. Salvage value should not be, no, salvage value is in the cash form. You have to take it. We got this number correctly. This answer is perfectly fine. It's matching. A is the right answer. But my answer with using financial calculator is little different from the right one. Let's do it again. So our cash flow, 320,000 initially. Negative. And then we have 80,000, 4 cash flows of 80,000 each. Enter, down arrow key, 4. And we take last terminal cash flows to be 300,000. Enter, down arrow key twice. Take your NPV at 20% and compute 7662. This is right. This is the correct option. This is the right thing to do. Because the problem is if we take 85, this may be considered a 6th year cash flow. So this would be wrong. So what we do, we divide our cash flows in this way. Please note, this is a very fine point to be understood. If you want to use the financial calculator, then what you should do, you take 80,000, 4 payments, and the last 80 would be added with the disposal amount, so 300,000. This is the right thing. So take these as 4, and this is a single cash for the 5th year, and then you'll be able to do it. Right? So yes, you can see 7662 and 7720, they're quite close. So this is a more accurate number, and this disposal amount has to be taken. It's in the cash form, salvage value of equipment in 5 years. You will receive this, and this will become as a part of your inflow. Okay, people, so we got it. Moving on to another beautiful question. And what this question says, exactly, Alex, that was the mistake. So this is the important point to be learned, that the 4 cash flows are 80 and 5th year cash flow is combined with this one, so that the calculator doesn't misinterpret that these are for first 5 years, this is for the 6th year. So that's clearly was the mistake. So this is a good point. We brought it up here. So we have a question involving some multiple parts. Let's see what it says. We need to find out the discounted cash flow for the 4th year MACRS depreciation. Let's read the question in full. The following data pertains to a 4-year project being considered by Metro Industries. A depreciable asset that cost 1.2 million will be acquired on January 1st. The asset, which is expected to have 200,000 salvage value at the end of the 4-year. Initial investment 1.2 million for the machine. The salvage value is $200,000, and it qualifies as a 3 years property under modified accelerated cost recovery system. Remember, the tax rates are specified in the tax laws in the US. The machine which you have acquired, the depreciation rate on this machine is to be applied at 33% for the 1st year, 2nd, 3rd, and 4th. So MACRS, these are the depreciation rates required under the tax laws that you need to use in your investment decision. Because in investment decision analysis, the depreciation rate, if it's different than the accounting rate, because there may be 2 different methods of depreciation. One is the accounting depreciation, other is the tax depreciation. It's the tax depreciation we should use. This is the important point. So this property qualifies for 3 years property. Remember, if it's MACRS for 3 years, you will get 4 rates. And this 4th year rate, basically this 7, represents the book value of the asset at the end of the 3rd year, right? If it is given that the asset qualifies for 5 years property under MACRS, you will see there are 6 rates. And the 6th year rate is basically the book value of the asset at the end of the 5th year. So we have been given the depreciation rates, 4-year project. This asset will replace an existing asset that has a tax basis of 150, and it can be sold for 180 on 1st January at the start of the project. The project is expected to provide added annual sales of 30,000 units at 20 each. That's the selling price. Additional cash operating cost will be $12 per unit. That's the variable cost, and fixed cost of $90,000. Fine. It further says a 50,000 working capital investment is fully recoverable at the end of the 4th year. So this is initially invested as outflow, and full amount is collected at the end of the 4th year. It further says the tax rate applicable is 40%. Metro is subject to 40% income tax rate and rounds all computations to the nearest dollar. Assume that any gain or loss affects the taxes paid at the end of the year. Any gain or loss on any transaction, tax associated with that gain and loss will affect the end of year cash flows, not at the date of transaction. That's a very important point. The company uses the net present value method to analyze investments and will employ the following factor rates. These are the present value factors for 12%. This is the present value of an annuity. We are required to find out what? Discounted cash flow for 4 years MACRS depreciation. We can't use any other depreciation method rather than just these rates. So your asset is worth $1.2 million. Depreciation rate for the 4th year is 7%. Had the question asked what is the depreciation expense for the 3rd year, you would have multiplied 1.2 million with 15%. So 1.2 million times 7%, this is the depreciation expense. 1.2 million times 7%. This is the depreciation expense for the 4th year. We need to calculate the depreciation tax shield, DTS. So DTS, depreciation tax shield, is the depreciation times tax rate, which is going to be 33,600. This is the depreciation tax shield at the end of the third year. Since we needed the discounted one, this tax shield is achieved at the end of the fourth year. In order to bring it in the present term, you need to discount it absolutely, Ahmed. We will multiply it with 0.64. So first step is to calculate the depreciation for the fourth year. Second step is to calculate the tax shield by multiplying depreciation with the tax rate. Once you have the tax shield, you multiply it with the discount factor to convert this tax shield from the fourth year to year zero. So that's exactly what we're going to do. 33,600 times 0.64 gives you 21,504. This is the present value of depreciation tax shield, which we will achieve at the end of the fourth year. This way you may be tested to calculate any one component of a large investment decision question. But since this question is basically an essay type, same question has multiple subparts. So such questions can, and they do, come on the essay section of your exam. So very few students were tested, but they are tested. Essay questions may involve section E. So what else? The next part, it says the discounted net of tax amount that relates to disposal of the existing asset. This is interesting because it says any tax effect of disposal gain on loss occurs at the end of the year, whether it's 1, 2, or 3. Let us see. We have an asset with a tax basis of 150 and being sold at 180. Clearly, there is a gain, no doubt. There is a gain of $30,000. And this gain is taxable. This gain is taxable at the rate of 40%. That is $12,000. Interesting, this tax is paid at the end of year 1. So the question says the discounted net of tax amount that relates to disposal of the existing asset. Now, this is a very, very interesting question, and I guess only one of its kind, where you receive the full disposal amount right now, and tax related to this gain needs to be paid at the end of year 1. Why? Because the question says, assume that any gain or loss affects the taxes paid at the end of the year in which it occurred. Since this transaction occurred at the start of the year 1, tax related to this gain will be paid at the end of year 1. And how much tax you're going to pay? You're going to pay 10%, 40% of the gain. What gain is 150 versus 180. 30,000 gain on disposal, tax on gain is 12. So you pay this 12,000 at the end of year 1. Since we want to calculate the present value, you need to calculate the present value of this $12,000. And what you do, you multiply this first year outflow with the first year discount factor. So 12,000 multiplied by 0.89 gives you 10,680. So the point is, you receive 180 right now, absolutely, as the disposal proceed. But you're going to pay tax at the end of the first year, $12,000. This tax, ladies and gentlemen, needs to be discounted because this 180 you receive right now, this tax has to be brought in the present terms as well. So the net impact of these two is 169,320. So this is the discounted net of tax amount related to the disposal transaction. A fantastic part, not anywhere else seen. B. Same question, but this time we need something else. It says the incremental sales, whatever we were selling, fine. Now, because of this new project, we are going to sell 30,000 units additionally. So this additional sales, incremental sales, will provide discounted net of tax contribution margin over 4 years. Interesting. Instead of calculating NPV, we are required to do these things this way. So first we need to find out what is the contribution every year. Contribution is sales price per unit minus variable cost per unit. So its contribution per unit is $8, right? We sell 30,000 units every year. That means 8 times 30, the contribution every year is to $40,000. This is before tax contribution, right? You can say it's before tax cash contribution. From this contribution, we need to deduct tax at the rate of 40%. So 240 times 40%, 96,000. You sell 30,000 units every year. Contribution each unit is 20 minus 12, 8. 8 times 30. This is the total contribution before tax. You don't need to deduct fixed cost because we need contribution margin. You would have been right had it asked to calculate the cash flows, right? So we need to take contribution, sales minus variable cost. So 240 less 96 gives us after-tax contribution. After-tax contribution is 144 every year. So you receive 144 in year 1, 144 year 2, 3, 4. So this cash flow comes all the years till year 4. So since this amount is repetitive, so you're going to multiply this with annuity factor for 4 periods at 12%. Right? So it's 144 multiplied by 3.04. Alex, if the question had asked us to calculate the cash flow, the present value of cash flows, then we would have deducted the fixed cost component as well. So it's going to be 144 times 3.04. It gives us 437,760. That is the answer. D is the answer. Next, same question, but this time the question says the overall discounted cash flow impact on the working capital investment. Working capital outflow is 50,000 at the start of the project, and then it is fully recovered at the end of the 4th year. It says, what is the overall net impact of working capital investment? You have 50,000 right now. This 50,000 is recovered at the end of the 4th year. How much is it worth in present terms? For this, you multiply this cash flow with the 4th year discount factor, and that converts this 50,000 into its present term. So the point is 50,000 you invest now. What is recovered at the end of the 4th year? It's worth 32,000 only. That means the net impact is 18,000 negative. We don't need any tax impact on this because working capital recovery isn't any gain or loss. It's just that what you invested in working capital is being recovered. There's no gain or loss. So that is the answer, right? So this is how we go about it. Since it required only some part of it, so maybe the use of financial calculator isn't recommended here. Next, this is interesting. We have 4 options to evaluate, and each of these options have different types of cash flows given. And we need to find out which one is the better one. Nolan Corporation, or rather Nolan Hospital, has decided to acquire diagnostic equipment from Weber Medical Products based on Weber's reputation for quality. Weber has offered Nolan 4 payment options. That's the question doing rounds in a WhatsApp group, the term payment. The payments made in parts rather than the single payment at the start of the project. So it says there are 4 payment options as shown in the table below. All payments would be due and paid at the beginning of each year. This is something very important. So what you see here is one, this is basically payment made at the start of the project. So it's better to do this question by revising these numbers. This is basically year 0. This is 1, this is 2, this is 3. Because this 5 million is paid at the start right now. So this is advisable to do it this way. Again, this is a tricky part. It says all payments would be made due and paid at the beginning of each year. So when you see year 1, normally in our convention of these questions, we consider when you write 1, that is end of year 1. 2 means end of year 2. But this question says cash flows are occurred or are made at the start of the period. So it's advisable to change these to 0, 1, 2, 3. That will be much feasible. Now we have to find out which of these options is suitable. First option says pay 5 million right now, then 5 million at the start of year 2, or at the end of year 1, 5 million at the end of year 2, and then 5 million at the end of year 3. Either this or simply make 2 payments, first at the end of year 1, at the end of year 2. Or a single payment of 18 million right now, or a single payment of 22 million at the end of 3rd year. Since these are outflows, we're not talking about NPV here, we're talking about outflow. We would like to get the highest positive NPV. Inflows must be as big as possible, good for us. And outflows should be as little as possible. So in this question, we want to calculate the present value of outflows, and we want to get the one which results in the lowest present value of outflows to pay as little as possible. So let us evaluate these options one by one. First, present value for outflows, option 1. There are four payments, of which 3 must be discounted. 1 doesn't require any discount because it is paid right now. This 5 million is being paid right now. So in present term, it's 5 billion. But these remaining 3 payments will occur at the end of year 1, 2, and 3. So these 5 million payments needs to be multiplied with the annuity factor for 3 periods at 8%. Second, these 2 payments that you're going to make, this is the second option. 1 payment will be made at the end of year 1, discount factor for year 1 at 8%. Another payment will be made at the end of year 2. Or you may use annuity factor for 2 periods. Is to do it quick way. Yes, you can do that. You can do it in quick way because they are 2 consecutive years, so you can use annuity factor for 2 periods. Annuity factor for 2 periods at 8%. Third option will do all these. The third option involves a single payment right now, 18 million. It requires no discounting. It is 18 million in the present terms. No computation needed whatsoever. And the fourth option involves a single payment at the end of the 3rd year. That is 22 million, a single payment at the end of the 3rd year, single payment. Whenever there is a single payment, use discount factor for the 3rd period at 8%. So I'm going to write their numbers as I can see in the table. So this annuity factor for 2 periods is, for 3 periods is going to be 2.577. Annuity factor for 2 periods, 0.926 plus 0.857, 1.783. And this discount factor for the 3rd period is 0.794. So if you equate, this one is going to be 17.885, 17.885 million. This one is going to be 17.82 million. This is full 18 million, no discounting needed. And this last one is going to be 17.402 million. Yes, so you can see absolutely right, Ahmed. The last year cash flow, the last option is the lowest. Now, let's say this is a good question for practicing financial calculator and see, match the results. Do we get the same numbers? So let's try them out. So bringing the financial calculator to the picture, this question is worth 4 questions alone. The single question is a combination of 4 questions. So let's try them out all one by one. So in the first option, we have 4 payments to be made. One is paid right now, and all of these are the payments. So I'm going to put the negative sign. So I'm going to take first year cash flow, which is being 5 million negative. Right now it's being paid. So please make sure you understand this well. This is the first payment. And then there are 3 payments. Frequency 3, down arrow key, and you have the discount factor 8%. Did I miss anything? Oh, I totally omitted. I need to put negative sign with all. This is important because all these outflow, rather than putting negative with all, take all positive. It'll simply, we know it's an outflow, so we don't need to confuse ourselves with numbers. So let me do it again. So the first outflow is 5 million. Second is 5, and it is for 3 periods. Discount rate is 8. 17,885, right? 17,885, right? So we got it. So we don't need to confuse with numbers. Just take 5 million initial outflow as positive 5 and take these 5 as a sequence of 3 cash flows. So we got it, 17.885. So I would recommend financial calculator can be sometimes tricky. Like in this case, there are no cash flows in the year 1, 2, only single cash flow. So I recommend that you use the table instead. So the calculator will be beneficial when you have stream of cash flow, so you can put them in the sequence. What is the frequency? Sometimes it can be a little messy. So I hope you got the idea. This way, they are much more easily manageable when the cash flows are quite discontinuous this way. But when you have continuous stream of cash flows, like in the previous question, then you should use. Let's do another question. As I told you, the IRR questions are related to your exams would involve either a single regular cash flow or a maximum of 2 types of cash flows. They're still manageable. But what about the question like these, where you're required to find out IRR? No calculation required, just use common sense. Standard companies considering 2 mutually exclusive projects, either A or B. NPV profile of these projects is given below. If you keep on increasing the rate of discount or discount rate, your NPV will continuously fall. Look at project A. If discounted at 14%, this is the NPV. Project B, if discounted at 14%, this is NPV. If you raise the discount rate to 20, A gets a negative NPV and B's NPV falls from 327 to 128. So that tells you that as you keep on increasing the discount rate, the net present value will continuously fall. The question says, what is the approximate internal rate of return for project A and B? IRR estimate. Look at this. We know IRR is that discount rate at which the NPV becomes 0. So project A has a 0 NPV somewhere between 18 and 20. So more likely it's either B or C. Let's do the same for project B. Its NPV is becoming 0 somewhere between 24 to 26. That is 25. Now this is perfect. 25.5 and 19.5, these are the IRR. So we didn't do any calculation. We didn't do any calculation and we got the answer. Ahmed said D. Ahmed, C. When you take D, you have gone beyond 20 because our NPV is getting 0 somewhere here, not beyond 20. So it's between 18 and 20. 20 is the upper limit. So it means either it's B or C, right? And for project B, it is somewhere between 24 and 26, not beyond 26. So that means you reject this also. So that has to be C. It has to be C. Okay, next. It says tenant companies considering same question. The company president is of the view that project B should be accepted because it has a higher internal rate of return. The president is requested John Mack, the CFO, to make a recommendation. The company's cost of capital is 10%. Which of the following options should Mack recommend to the president? First of all, whenever we find a conflict between IRR and NPV, and project is mutually exclusive, or project with unconventional cash flows. Okay. It was a previous question. All right. So whenever we find a conflict between NPV and IRR, we should always side with NPV. Recommended. So it says, agree with the president? No, IRR is in isolation is not the best criteria. So this is not right. What about B? Accept project A because it has an IRR higher than that of B. This is not right. In fact, project B has a higher IRR. It has got about 20, somewhere in between. That is 25%. So this is statement itself wrong. And then recommendation would be wrong also. It says accept both projects A and B as IRR for each project is greater than the cost of capital. That is true, but since the projects are mutually exclusive, we can't take both of them. We have to take one out of these. So this rules out option C as well. Then accept project A because at 10% discount rate, it has an NPV that is greater than project B. This is the 10% threshold. And at this threshold, project A has a higher NPV, and that is our selection criteria because NPV is the absolute increase in the shareholders' wealth in projects. So if we need to decide between two projects, IRR may conflict, we go for NPV, and that makes D to be the correct option. So guys, that is all. There are more questions, and we may attach these questions next week with discounted payback and payback. And we need to do one question. I will try to find it, else Ms. Maha will share. This question involves, I think it's one question of its kind. There's no other question like that, which has the use of these tables, which we never use. Future value to annuity and the future value of single dollar. So that question will make use of these tables also. So in case if you get a question like this, which requires calculations of future value of the investments, how it's done, we are going to do next week. And guys, that's all for this week. Next week, we are going to wind up our section E. We will do discounted payback options, and little revision. And on 3rd of June, Monday, we are going to start our P2 from zero. Basically, your ethics is the starting point of your CMA part 2, because way back in 2015, ethics was studied at the beginning. Ethics was a part of your section A. And ethics has no association with any other section of your CMA. So you may consider those who want to restart or want to start for the first time, ethics is the starting point for them. So that'll be on 3rd of June. That's all for this week. See you guys tomorrow with this connection of NPV and IRR towards payback and discounted payback. So that's all. See you guys. Take care. Good night. Bye-bye. You guys, Allah Hafiz. Take care. Good night.